Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have Dave Allred, managing partner of Axia Partners and a diversified real estate investment firm. Dave and his partners have $140 million under management and over 400 investors. Dave, you have an interesting background in sales, growing companies. So tell us about that and how that led you into the real estate space.
Weston, first of all, thanks for having me on, man. Excited for this podcast. So I grew up in a small town here in Utah, and actually started out knocking doors for a company called Vivint Smart Home, Vivint Solar. One of the hardest ways to make money, and it was extremely challenging, but I learned a lot of life skills from that. It's supposed to be, 4-month summer season out in Chicago, and ended up turning into a 16-year leadership career, managing 121 sales teams in 41 states. And I learned a lot. It was a really a great growth opportunity to see this small company go from really nothing to we IPO'd, went public for 2.2 billion valuation. And so it's fun to be, an integral part of that process and be able to have a front row seat. But yeah, came from a small town, very low income family, very dysfunctional, low income family. Ran away when I was 16 and, really never had, a lot of experience or conversations around investing and, business and scaling and, being financially responsible. But when I jumped out there and did that summer sales job, my first year I made $31,000, which to this day was probably the most important money I've ever made in my life. Came back the next year, made $156,000 as a sales manager.
Wow.
And I went to my CPA and I asked him, what are all of your wealthy clients doing? Because I thought I was wealthy, right? And he said they're either buying businesses or investing in real estate. And I thought, yeah, I know nothing about real estate, but I'm going to become a student of the game and just really, dedicated myself to learning. And I've always believed there's power in proximity, so I try to align myself with other people doing what I wanted to be doing. And I'm so grateful for that, man, because real estate has created this amazing amount of not only financial freedom but also time freedom and lifestyle freedom for me and my family. And yeah, I love real estate, very passionate about it. One of my goals in my life, mission statement, is to help at least to create direct value for at least 10 million people and help at least 1,000 people become financially free through real estate investing. And so started, so that was a 16-year career, but along the way, I was aggressively taking the active income that I earned in commissions and sales and deploying that into passive income real estate. And so, when I first got started, I bought 4 townhomes. They were actually from the courthouse, short sales and bankruptcies. And so I bought those 4 for about $100,000 a piece. A few years later, they were worth about $200,000. And so I 1031 exchanged those 4 townhomes into 4 brand new fourplexes with no additional cash out of pocket, right? Just that velocity of money and parlaying that equity as a down payment. A few years later, those fourplexes appreciated about $250,000 a piece. So I 1031 exchanged those 4 fourplexes into 12 fourplexes with no cash out of pocket, and did the same thing again, 3 years later. And so I was able to go from 4 units to 62 units without putting any additional cash into those deals. Yeah, I just fell in love with the game, real estate. Then I started 1031 exchanging into larger multifamily. Did about a dozen large multifamily syndications across the country with a lot of the guys that you've had as guests on this podcast, and learned a lot about it. Helped bring a Top Golf into Utah here. Really proud of that one in our backyard for the community. And then, I started investing into real estate funds, and I fell in love with the fund model. I have about 400 investors, and they're all my friends, family, my social network. And I'm really proud of being able to say I've never lost a dollar of investor capital ever in real estate investments. And I want to be able to protect that reputation. And so instead of doing syndications, I decided to go into the fund world. And we launched Axia Partners here in Utah about 4 years ago. And it's been a great ride, man. So happy to jump into any more details there, but that's kind of the high level overview.
Sure. Yeah, no, I appreciate you going into detail there. So, you started as an active investor, and you said you fell in love with the fund model. Um, did you invest passively first before launching your funds?
Yes, yeah, I invested in probably half a dozen different real estate funds. And the primary benefit that I saw and I still see today is in a fund, you have a lot more downside risk mitigation, right? Instead of investing in one address, you're investing in an entire, basket of assets. And so, yeah, so that was probably the primary reason for moving to the fund structure. Secondarily is just the ability to operate at scale, to be able to create value for a lot of people. On average, we have, a few hundred investors, in each fund offering. And so you can create real value and impact for a lot more people. And then also, as a syndicator, it was always stressful when you go under contract and you have 60 days, 90 days to go out and raise the capital. So it's this scramble to go out and get the capital needed to close. Whereas with a fund, you're already fully capitalized. And there's a lot of examples I could share, but that's been really powerful when we go into these very competitive bidding situations. When we can come in and say, "Hey, we're a fund, we're fully capitalized, we have proof of funds." In fact, we even closed on a deal a few months ago in Oklahoma where it was a distressed seller, and we were able to come in well below two other offers. And because we were able to close quickly, all cash, we were able to win that deal. And then we just refinanced it a few months later. So yeah, anyway, those are some of the primary reasons why I love the fund structure versus
Yeah,
syndications.
and that's what John Pennington and I talked about. He's from Utah as well.
Yeah, I know John well.
Um, yeah, he's an awesome guy. He had $28 billion under management at the time of his retirement, and he started in syndications, and then he pivoted to the fund model for that exact reason you mentioned. It's diversification, flexibility, and you don't have to scramble to raise capital. So, yeah, you guys have created a business out of this. You started yourself. You've created Axia Partners. So tell us more about your funds and your investment strategy. How can investors benefit from partnering with you guys?
So so when I retired from this 16-year leadership career, went full time in real estate. After a few years of doing that, I really I missed the interpersonal aspect of a leadership career, right? Managing again thousands of salespeople across the country. And with real estate, I spent most of the days sitting on my office looking at spreadsheets, underwriting deals, looking at pro formas, and I really missed that human aspect of it. And so, what we decided to do when I launched Axie Partners is I came up with this motto for the firm, and we call it experiential investing. And what that means is it's not only, chasing a strong ROI for our partners, but it's also an ROE, a return on experience and education. And so what we do is every single month, at least every quarter, we have some of the top guys in the industry come in and do a 45-minute webinar with our investors and then a 30-minute Q&A session. So they're able to just learn how we do what we do. Every time we close on a deal, we hold an experiential webinar and we show our LPs exactly how we found the deal, the business model, how we source the debt. And it's just full transparency. And it's been fun because it's an opportunity to really create value for people. It's a unique value proposition that I've never seen another firm do as well as we do. And so it's just a commitment to true transparency and a focus on education. So it's almost somewhat what like a real estate mastermind, but it's exclusive for our partners. Even when we go out and we do a site visit, we'll invite our LPs to come out and walk it with us. And what I found is a lot of people want to be doing these type of big, larger commercial real estate deals. They just lack the confidence or the competence to be doing it on their own. And so, so not only are we striving to get them a great return, but it's also, an education from that as well, which I get a lot of fulfillment out of personally. So that's kind of a fun part about what we do. When we first launched, so the second thing I would share there is, I mentioned earlier, I've never lost all investor capital in any real estate investment, knock on wood, right? But I'm really proud of that. And so every time that we approach any investment opportunity, the primary focus is, hey, how do we make sure we don't lose in this situation or in this deal or in this fund? And everything that we focus on is recession resilient real estate. So primarily we focus on multifamily. I love multifamily. It's bread and butter. It's really where I cut my teeth, personally in the real estate space. But we also love self storage. It's been the little darling of commercial real estate. And it's been one of the most recession resilient assets in the last two, big corrections. In 08, 09, 2010, they only saw about a 2% dip in self storage compared to the norm. We also love RV parks. RV parks, we feel like it's a diamond in the rough. There's not a lot of institutional money chasing that asset class. And they're incredible cash cows if you can manage those correctly. The one lesson learned though with RV parks is it takes a lot of bandwidth. When you buy an RV park, it's literally like buying it's like a new business almost. It's just a lot of hands-on management. And then we also are very bullish on industrial warehouse. In fact, we just completed a $50 million industrial warehouse project, Class A, 232,000 square feet here in our backyard, Salt Lake City. And so those are the four asset classes that we primarily focus on. Our first fund, we raised $20 million, raised it very quickly. It was a multi-strat fund. So we had RV parks, self-storage, and multifamily all in one fund. That fund is doing very, very well, overperforming our targeted returns. And then we've done another fund called the Value Development Fund about 2 years ago. We raised about $30 million and acquired some industrial warehouse as well as a few multifamily assets. And we also do, it's a pretty creative structure. I would say we're very nimble in our approach. We're a relatively small firm, and so it's just whatever we can do to create the best return for our partners. And so we get a little creative. Sometimes in the fund structure, if we have a really big deal we're taking down, we'll have the fund participate for a portion of the capital needed. And then we'll also run a kind of a dual track process with an SPV. So for example, let's say we have a multifamily deal and it's a $20 million equity need. One of our funds can come in for 10 million of that, and then a SPV for the other 10 million. And we've actually had a lot of success with that. I just want to share that as an idea. What I found is a lot of investors like the blind fund where they get the diversification, but some investors really like to be able to see the tangible asset and know exactly what they're investing in. And so taking that approach really allows us to cater to those different type of investors. Looking forward with our new fund, which is actually launching here in the next few weeks. By the time this podcast comes out, we'll probably be live. We're really excited about this. It's in the past, we've always ran what's called the 506B offering, which is reserved for, friends and family, people you have a relationship with, a pre-existing relationship. This new fund, we're doing a 506C offering, which allows us to cast a wider net. And so it's, we can publicly solicit, we can, share it on social media, we can talk about it on podcasts, etc. And we're really excited about it. It's a way to be able to help create value for a lot more people at scale. And, but then to take that even further, what we're doing with this offering is we're coupling the 506C offering with a Reg A offering as well. So it's actually two different vehicles underneath one offering. So we'll have a pitch deck, and based on if they're accredited, basically if they're an accredited investor and they're a 6-figure, 7-figure investor, they're going to automatically go into the 506C offering. If they want to make a smaller allocation or they're not accredited, then they'll kind of shift down into the Reg A offering. And so it's just a way to be able to provide access to a larger demographic. So really excited about that approach. I feel like it's quite innovative. I haven't seen a lot of other groups taking that approach, but it's been a lot of work, man. About 6 months in the behind the scenes working, getting things prepped and lined up for this. But ready to rock and roll, man. Super excited about it.
That's awesome, and we'll tag your website and ways for people to get in touch if they're interested in investing in your new fund that you're launching here soon. So, what are the typical projections and the timelines of your previous funds, and then what you think the next fund is going to be, if you can share that?
Yeah. So in the past, again, mainly focused on multifamily, we've been targeting a return structure anywhere between 17 to 21% net IRR for our partners. Multifamily as a whole, those IRRs have definitely come down a little bit. I'd say most funds right now going to market are, targeting more, between 12 to, maybe 12 to 17%. It's more, interest rates, the overall capital market environment. And then generally it's a 5-year term. So we're targeting about 3 years, best case scenario, 5 years at the longest. So generally on a value add deal, we're going to take about the first 18 months to implement the renovations. Take the next 12 months to really stabilize that, and then start looking at dispositions. We love value add, by the way. Almost every single project that we've taken down, and including our funds, are focused on a heavy value add approach. It's not just the traditional value add of, throwing some lipstick on the pig. We still do the paint, new granite countertops, appliances, all that. But it's a more unique, a little more innovative approach on value add. We also focus on, more modern amenities like, dog spas, shared WeWork type office space in the clubhouse. SEO, really focusing on rebranding the asset, creating a presence on social media. Nowadays a lot of tenants are actually very active on social media, and so if we can have a good representation of our projects there, that's been very valuable for us. And so it's always very heavy value add, and part of that goes back to the whole idea of recession resilient real estate, and making sure we protect our downside risk. If you can go in and create real value through your sweat equity and all this heavy lifting, it just creates a bigger buffer there in a worst case scenario if the market turns. And we always run with what we call it, it's called a European waterfall versus an American waterfall. And I'm always surprised how many investors don't understand what that difference is. Long story short, a European waterfall is a lot more generous or friendly for the LP. So the way we run our offerings is, we have to make sure we get 100% of the basis back to our partners, plus a pref rate, usually 7 to 9%. And then and only then are we able to participate and take chips off the table as the GP sponsor team. And so, and one other thing that we've done is we made a strategic decision as a firm that we will pass along 100% of the tax benefits to our LPs. And so, we always perform a cost segregation study year one, and we've been able to create some really, really strong tax benefits for our partners in that first year. Historically it's been, anywhere between, 55 to 80% in a year one depreciation benefit. So we have a lot of larger investors that actually come in more so for the tax benefits than for the cash flow or the equity appreciation. It's been kind of an interesting lesson learned over the last couple of years here. With this new fund we're launching, because multifamily has, the IRRs and those cap rates have been compressed a little bit. What we're doing is actually, I'm really excited about this. And Wes, and I'll try to keep it really quick here, but it's basically a barbell approach where we're raising $50 million of new equity to go out and acquire, $125 to $150 million of commercial real estate this year. And it's called the Axia Distressed Opportunity Fund 3. And so the focus is going out and finding distressed multifamily. We focus on mainly, primarily red states where there's less government intervention, eviction moratorium, some of those things that we can't control, and tertiary markets, and a little bit smaller deals where we're looking at, 70 to 225 units. And we just found that those tertiary markets, there's not as much institutional focus and money going in, so we can find better deals in those markets. But what we're looking for is really the financially distressed assets. We were hoping to see a lot more of that last year in 2024. We didn't really see a lot of distress coming online. This year, I think there's about $670 billion of loans maturing here in 2025, 2026 in multifamily. And so we want to be poised and capitalized to go and really, be opportunistic with those deals. And so when I say distressed opportunistic multifamily, it's not so much where it's, it's in a foreclosure. It's where they're having a hard time with their DSCR covenants, or they've applied irresponsible debt with, maybe they had some rate caps that expired. They've got hard money loans, bridge loans, and they just can't maintain their DSCR covenants. So we can come in those situations and, again, just be able to get a really good basis in the property and then come in on top of that with the value add strategy and be able to create a great yield for our investors. So we're targeting an 18 to 21% yield on this one. But the other side of this, this barbell, if you will, is what we're calling a return enhancement strategy. And so a portion of the $50 million being raised will go towards truly distressed opportunities, meaning, this is courthouse, this is a full bankruptcy. These are the type of deals that are, working through trustees. And one of our partners has a vast experience. He's done hundreds of these distressed deals. And so those deals will bring them in, and sometimes even just buying the deal and then turning around, putting it on the open market. Sometimes just a quick value add. Maybe it's fixing some of the, zoning issues or title issues. And so on that side of the fund, we'll actually rotate that several times throughout the 5-year hold period. And so what I love about that strategy is, we can target a higher IRR for our partners while still maintaining a conservative, down the middle of the fairway value add multifamily approach on the other side of the spectrum. And so anyway, we're really, really excited about it. It's a very unique approach to, a multifamily real estate fund structure. And last thing, Wes and I share on that is, usually when you invest into a value add multifamily, syndication or a fund, there's really not a lot of cash flow for the first, 18 months, maybe 2 years, because of that J curve. As you work through those renovations and those improvements, you actually want to have the occupancy drop a little bit, right? So with this fund structure, and with rotating through these truly distressed assets a little bit quicker, we're able to create cash flow much, much quicker for our partners. And so all of the profits that come from those assets will be distributed on a quarterly basis. And so that way we can actually start doing distributions. So we're targeting 6 months in and start getting some pretty healthy distributions going out for our partners while we work through the J curve on the renovations and the improvements. And then, once that's done, call it, month 18, month 24, then the cash on cash returns get really good. So.
Yeah, and what do those numbers look like that you project? I know years 1 and 2 are a little lower than, after you stabilize the property. So what are the cash flow numbers that you project giving to investors on a quarterly basis?
Yeah, so the way we're structuring this one is we're providing a 9% pref rate, so a little above market on the preferred return. 5-year hold period, traditional 2 and 20 on the terms. However, for larger allocations, we actually have 5 different classes of shares. And so depending on the check size, it can go anywhere from a 70-30 split all the way up to a 90-10 split. And so that's just a way to be able to help incentivize and create an alignment there to encourage larger check sizes. And so any net positive cash flow gets distributed on a quarterly basis. We're targeting about a 6-7% year 1 cash on cash, and then it'll increase a little bit into the second year, but we'll really see that pop in the cash on cash in year 3 once we've gone through all those improvements and the renovations and stabilized the multifamily side of this business. And then we're closer to, we're in the double digits on cash return. And then, most importantly, within that 3 to 5 year period, we're targeting between a 2 to a 2.4 equity multiplier, right? So if somebody comes in for $1 million, we're targeting getting them back, $2 to $2.4 million in proceeds as we wind down the fund.
That's huge. Yeah, just to pivot here to how you guys raise capital. So you have over 400 investors in your different funds. How have you gone about raising capital from individual investors?
Yeah, what's interesting is that I've actually never paid for a lead or an ad or any of that. It's just been very organic. It's all my social network. It's friends, family, previous employees that worked with me previously. Like I mentioned, I worked with thousands of these guys, and as in a leadership capacity. And so when I stepped out of that role, I still had a lot of relationship capital with those individuals. And so to be able to break down the barrier and help these guys get into commercial real estate was frankly pretty easy. And then when you've won for these guys over a long period of time, there's a lot of trust there. And so what I'm probably most proud of is just the amount of repeat investors. And so it becomes, gets to a point where, they still do their due diligence, but it's literally like, okay, we've done this so many times already, and there's a lot of trust in the due diligence and whatnot. So, yeah, it actually becomes a lot more fun. One of my mottos and my goals has been, I want to attract capital, not chase capital. And, I think when we all get started, we definitely have to chase, and it's just part of the process. But, when it really got fun for me is when it went from chasing to just attracting capital. And so, there's a few things that have helped there. Um, but, I think a lot of it's just being able to explain and articulate, why multifamily and why real estate's so important. And, for me personally, maybe part of why it's been compelling is because of my own personal story, coming from nothing and being just so hyper focused on creating financial freedom for my family. I've got 4 kids now, ages 10 through 18. And I've been just hyper focused on, hey, how can I create true financial freedom, which I would define as having enough recurring passive income or mailbox money to be able to cover your family's cost of living. And in fact, so when I was 30 years old, I've been, talking about wanting financial freedom for a long time. But there's a big difference between wanting something and being committed to it. And so I remember very clearly, I sat down on a Sunday, 4 hours, pulled a spreadsheet up, and I'm like, okay. And I created what now I call it the financial freedom equation. And it's a really simple practice. And I challenge your listeners to do the same. Or even better, if you jump on my website, it's daveallred.com. You can actually download this as a free resource. But it's called the financial freedom equation, and it's simply putting in the first line, what's my financial freedom number, and that's everything included, right? It's your car payment, your mortgage, your gas, utilities, all of it. So let's just say, as an example, it's $200,000. The next line item is, well, what my current passive income? Let's say you have $50,000 coming in from some townhomes or some dividend stocks or whatever. The next line item is what's the gap? So in that scenario, it's $150,000. The next line item is, how many years am I willing to commit to achieving financial freedom? For me, it was 10 years, right? I'm 30 years old. I'm like, okay, by age 40, I want to hit this. And then the next line item is dividing that $150,000 by the 10 years. And so that's $15,000. So I just need to create $15,000 of recurring passive income per year to be able to achieve true financial freedom. And then I reverse engineered that a little bit more and said, okay, well, how many rental properties do I need to have to be able to achieve true financial freedom? And the answer was 40 doors, right? 40 properties. And so my mantra became 40 by 40, right? 40 doors by age 40. I changed all my passwords to 40 by 40, my back screen on my iPhone. Everything was 40 by 40. Just got hyper focused on that. And hit that goal when I was 36, and then I decided to up that to 1,000 doors by age 40 and hit that. And then that's when I decided to launch Axie and really scale this.
That's huge. Yeah, and you've created a business out of it for sure. You mentioned social media before our call as well. You have 50,000 followers on social media. So do you use that for raising capital, and how do you promote your business on there?
I really haven't. I'll share sometimes just things I'm really excited about, and what I'm passionate about. For me personally, it was this focus on financial freedom we just talked about. And then once I achieved that, the focus actually turned from financial freedom to time freedom, right? Our greatest resource. And then from time freedom to what I call lifestyle freedom. And lifestyle freedom I would define as, living your dream life today instead of, someday down the road. And so, I realized a long time ago, Weston, that one of my core motivators is freedom. Like for Dave Allred, core motivator, freedom. I just want to have a ton of freedom in my life to be doing what I want to be doing, when I want to do, with people I want to be doing it with. I think that resonates, and real estate's really been the vehicle that's helped me achieve that. And so it's just being able to share it with other people that I care about. An interesting kind of a limiting belief that I think a lot of people have is, you should never be doing business with your friends, your family, or raising money. I actually would disagree full-heartedly with that. I feel like, if you believe in something and it's created value for you and freedom for you, like, why would you not want to share that with the people you really care about? Like the people your friends, your family, right? And so it's just kind of a different mindset and how you approach that. And so I think that's been really helpful is just this, a sincere desire to help other people to be able to create that same level, that quality of life and that freedom as well. So I think that's a big part of it. Again, repeat investors, that's probably it's a huge component of it as well. Um, you know, and then lastly, I just say is I love investing. Like it's something I've really enjoyed. Again, growing up, we never talked about it, but for me, investing, it's really just it's like this chessboard. You guys little chess pieces, and it's all about strategy. And I really love that. It's been really fun for me. And I do teach quite a bit about asset allocations. I've created what I call a tax deductible lifestyle where you can create businesses around your different hobbies and different things. For example, if I have a few second homes, but they're also short-term rentals and Airbnbs, so there's some tax deductions there as well. All of my kids are employees of my family's real estate group. So those wages are tax deductible to the company. They don't have to pay taxes because they're below the minimum threshold. Goes into a Roth IRA, all grows tax free. But just really being very intentional with how you approach taxes, because frankly speaking, and by the way, nothing fun about taxes, right? It's not a fun topic to really spend a lot of time on. But at the end of the day, it's not about what you make; it's what you keep. And taxes are the large transfer of wealth for most people. And so for me, if I can, defer taxes and buy more real estate every year, that's how you really scale a portfolio a lot quicker. One of my personal mantras in my life has been always do bigger deals than yesterday. And so if you're always looking to scale up and do bigger things, not only does it help you on a personal growth side of things and hopefully on your profitability, but it also allows you to continue to defer taxes, right? If you can do a cost segregation study and you keep doing bigger and bigger deals like that, it's really a beautiful way to compound wealth and build a portfolio. So anyway, kind of went on a tangent there, but hopefully that was helpful. A lot of times I kind of go to the family stuff. I guess I gotta say, like as a dad, like that's been so fun for me to be able to teach my kids about all this stuff. And all my kids, even my 10-year-old, they all have money invested with me into different real estate projects and fourplexes. We just create a simple JV joint venture. They'll come in, and the first Sunday of each month, we sit down and we measure their passive income, and it's on a little scoreboard. And so they're all actually very competitive with where they're sitting on that. And my daughter, I have two daughters that turned 16, and they both wanted a Tesla Model 3. And the first time that happened,
Same.
I was like, no, like hell no, that's irresponsible. It's a bad idea. My insurance broker's like, hey Dave, that's a terrible idea. Like it's a 30% chance of a claim in the first year. Anyway, after saying no for about a month, I realized the higher quality question is okay, sure, you can get that, but you got to figure out how to get enough passive income to pay for your Tesla Model 3 payment. And so, she sold off some of her cryptocurrency and some of her stock holdings from her investments. We took all that money, put into a fourplex with me, and that created enough passive income to almost cover her Tesla payment. And then we went to mom and said, hey, now we have a full-time Uber driver in the house to drive all the kids to sports and whatnot. So we paid her, for her hours. Now she's actually making money from that. But the beautiful thing is that her actual investment is in real estate. So it's growing, right? It's accumulating. And then the passive income is paying for this discretionary, luxury item that she really wanted. And so anyway, it's just a beautiful way of kind of, real life example of teaching kids. And yeah, anyway.
Yeah, a lot of families kind of shy away from teaching their kids investing or about money. They keep it separate from their family life, which I think is the opposite, and you think as well, is the opposite of what it should be. You should be teaching your kids about finances.
Wes, now take it even one step further, which is this year in 2024, we set a family goal to have all four of our kids launch their first business. And so all four of them put together business plans. They all launched. Three of the four are already cash flow positive. My son's business, it's a vending machine business. He's putting up a bunch of vending machines here locally. We haven't got that one cash flow positive, working on some supply chain issues, getting those vending machines in. But I got to tell you, man, teaching your kids to be entrepreneurs and just how business
So cool.
works, it's incredible, man. Like I've absolutely, it's probably what I've loved the most about actually, that's not true. Um, we celebrated our 20th anniversary. Went out to Santorini, Greece, with the family, and rented
Congrats.
a catamaran and floated around for 10 days, and it was incredible, man. It was so cool with the kids there. They got to experience the whole thing. Remarried my wife, whole vow ceremony. It was epic. But the seeing your kids as little entrepreneurs, dude, proud dad moment for sure.
That's so cool. Yeah, let's pivot into what you're seeing for the future of you guys' firm, Axia Partners. What are your goals for the future, and how do you see your firm changing and growing as well?
Yeah, so our goal is to become a best-in-class, multi-billion-dollar investment firm here in Utah. And frankly, a lot of groups talk about being the biggest. I don't really want to be the biggest. I want to be the best. And I want to make sure that we're enjoying the process, that we have fun showing up to work, that we have great quality of life for our employees, and then adding value for a lot of people. Again, I mentioned I want to be able to add value in this capacity for 10 million people. So that's one of my own personal goals. More specifically, we plan on launching on average, 1 to 2 funds per year. And, I really prioritize the repeat investors. So the idea is make sure we can win for them, provide great transparency, a great experience. And then, naturally they're going to be, they're going to come right back with us in the next offering. In terms of asset classes, we're always going to be nimble and just be paying a lot of attention to the markets and where things are going. To me, again, multifamily is just such a solid investment, just in every capacity. Whether that's looking at wealth preservation, accumulation, the tax benefits, or cash flow, it's hard to beat multifamily for the long run. But yeah, just continue to keep scaling. We've been working towards becoming vertically integrated, so we brought everything in house at the firm. Everything's in-house except for multifamily property management. So because we have a national footprint, we found that we can create the best experience for our tenants by finding best-in-class third-party regional property managers in these different markets. But eventually, I would like to bring that all in-house, and so we're looking at that in the next year or two. But yeah, I mean, really, it's about execution, right? So raising the capital is one thing, but being best in class at execution, I think is so important. In fact, I know a lot of other, syndicators and other financial groups that have, when money was really easy to raise, I'd say, 2020 through 2023, they kind of got over their ski tips. And because the execution, the SOPs, the systems, the processes weren't dialed in to be able to actually execute on the operation side of the business. And so we kind of took a little bit of a step back in 2024. I wouldn't say we took our foot off the gas, but we just took a little bit of a slower pace to make sure we had those things dialed in. And that's really important sometimes in business as you want to really scale and go bigger. Also, I mentioned one thing that I've really loved is collaboration. So it's teaming up with other GPs, doing co-GP scenarios or joint ventures with other operators. We've loved that, and it's a great way to be able to scale, not just scale, but to be able to learn from other groups and to be able to collaborate and create synergy. One of my favorite mottos is in life is who you do business with is who you do life with naturally. And so if you can be intentional with the people you want to be doing business with, and it just makes it a lot more fun, right? To me, the apex of success is where you're going to work, but you kind of blur the lines of if you're actually like hanging out with your friends or if you're actually working, right? Like that's where it really gets fun. So that's kind of the future. Create a lot of value, make sure we win for our partners, and just keep scaling. For me, I feel like building is energizing, right? I think anytime that you're in life and you're just maintaining and being stagnant, at least for me, that's when I've been the least happy. And when I'm the happiest for me is when I'm chasing the best version of Dave Allred, and we're really pushing our potential and really getting after it. And with as an example, this Top Golf that we did here in Utah, like I'll be honest, in hindsight, like it was a pretty scary thing. Like it was definitely a big project, but a lot of times in my life, it's just been, hey, take the bite. Even if you don't know how you're gonna chew on it, but just take the bite, and then you'll figure it out later on. And so, yeah. Anyway, I could go on and on that one, but yeah, just continue to push for the best version of the firm and operate with excellence.
For sure. Yeah, a lot of big things going going on with you guys. So, um, one last question for you, Dave, before we go. So, what are the main things an investor should look for when they're investing in a fund like yours?
So I think that the answer to that question is a little bit different for everybody because you really want to make sure you identify what your long-term outcome is. And I think a lot of times people make investment decisions based on emotion, FOMO, whatever else. And I love this expression that says the higher the emotion, the lower the intelligence, right? The higher the emotion, the lower the intelligence. So you really want to take emotion out of the decision and you want to really quantify things. You want to outline what exactly is it you're trying to accomplish. The more you get to know me, like I'm so big on intentionality. By the way, if you go to my website, daveallred.com, there's also a download on there. It's called Lifestyle Design. It's the 10 areas in my life I want to be great at, and it's all in writing. It's a whole template. That's been really huge for me to be able to, have like a true north of exactly what I'm working towards. Because most people go through life meandering, kind of just based on emotion. But if you actually know exactly what you're fighting for, not only is it easier, but it's actually more fun. It's more fulfilling along the way. So get clear on what you really want to achieve with your investments, and then reverse engineer it from that. Um, Personally, what I've done is because I get a lot of deal flow. I probably have a dozen deals coming in my inbox a day, and so I've created an investment criteria. I think it's on my website as well, but it's 12 different investment criteria. So Wes, you send me a deal, and literally within a minute or two, I can be like, okay, this is a pass, right? But I can actually quantify these 12 different data points and see if it's a good fit for what I'm personally trying to invest in. And so that's one thing I just recommend is maybe a best practice for everybody listening to this is write down your own personal investment criteria. Secondarily, is I created a spreadsheet a long time ago, and it's an investment scorecard. And so literally, has call it 200 investments that I've done in the first column, how much money was invested, what the ROI was, and then most importantly is lessons learned. So under that column, by every single deal I've ever done that's gone full cycle, I have my lessons learned. If it went really well, it's like, hey, great job on getting a personal guarantee, great job on having an attorney paper this, great job on your due diligence, whatever else. If it didn't go very well, it's like, hey, lesson learned. I shouldn't have, just done it because my buddy was doing it, or I should have, done better due diligence, whatever else. And so that helps us to find our blind spots and to become more sophisticated investors. So that's a great practice that I challenge your listeners to follow. But to be a little more specific, I think what's important to look at when you look at an offering is real estate, say a fund offering, is most importantly is do you trust the sponsors and what's their track record? I think that's if you don't trust the sponsors, for me that's just it's a non-starter. Number two is what's the overall performance, what are the target returns, what's the upside here. Number three is what are the tax benefits. I think a lot of people don't really prioritize that very highly. Number four is cash flow. Cash flow is king. I love cash flow, and anytime you can be getting positive cash flow from a real estate investment, it really does help mitigate a lot of downside risk because you're at least covering your debt service with a surplus there of positive cash flow. Plus, that positive cash flow is what it is the dry powder to create that financial freedom that we talked about earlier. Um, the market itself, I think markets is so important, even more so now than it has been in the past. Making sure you're in markets where there's robust employment. We really pay attention to positive net migration, where people that are trained, more people coming in. Simple supply and demand. Additionally to that, so cash flow, taxes, the market itself, the operators, their track record. The last thing I would say is, and maybe this is where I'm at in my investing career, but I really like to do deals with people that I like, and or where I'm going to be able to learn something from them. I mentioned earlier the concept of power and proximity, and so a lot of times I'll invest with people that are doing things of wherever I want to get to. Like I want to find people doing those, and if there's a fund or a syndication there, and I'm a lot more likely to deploy capital with them because they're going to help me learn more about how they do what they do at their level. And so that's been a really interesting, kind of a powerful principle for me through it's served me very well throughout my investing career, is to always look up to where you want to be, deploy capital, invest with them, create value for them, and that reciprocates by getting to know how they operate, their systems, their processes, even their people. And so that's been huge for me. So
For sure. Yeah, one last question, Dave. How can people get in touch with you, whether that's partnering, maybe co-GP, you said JV as well, or invest in your upcoming fund? So how can people reach you?
yeah, you bet. So our website is it's AXIA, axiapartners.com. On social media, just Dave Allred. I'm on all the platforms. I'm pretty active on Instagram as well as LinkedIn. My personal email is dave@axiapartners.com. And yeah, my website, daveallred.com. If you want to download any of those deliverables, happy to help there as well. But feel free to reach out. I'm happy to, I try to respond to all my DMs personally. So if anybody has any questions, concerns, opportunities, whatever else, feel free to reach out to me. And yeah, Weston, appreciate the opportunity to jump on here, man. This has been awesome.
Awesome. Thank you, Dave.
Thanks, guys.